Hey everyone, welcome to today's session on psychology for trading, but also for life as well. Hope you're doing well today. We're going to deep dive into maintenance mindset versus neglect mindset. This all actually stems from a book that I read recently called Maintenance of Everything by Stuart Brand. Great, great read. Highly recommend it. But basically, it got me thinking a lot about both trading and life as well. And so this is really all about the discipline of upkeep in both your trading and in your life and how it compounds into durable progress over time. So there are two operating philosophies here, right? And these come from the book. There's maintenance mindset and neglect mindset. These aren't just habits, they're relationships of time and effort that you put into your life as well as trading. So with maintenance mindset, these are small, unglamorous actions that are repeated consistently. So pretty much what you do day in, day out. You probably heard the saying that what you do every day, your daily habits, is who you become essentially. This mindset treats today's decision as data for tomorrow's decision, right? You're reviewing outcomes against the original thesis you make in your trading. This assumes systems decay by default and allows you to intervene when there are issues. It also measures progress in trends, not in single trades. So again, we're referring to journaling trades here, right? Documenting your thought process behind why you're making decisions. Very, very important to understand because, again, if we don't study ourselves and our decision-making processes, how can we ever truly improve? And this is where I see, I've worked with hundreds of people over the years now, and I've seen everything from success and failure, but primarily what I've seen is that those that document their results see the best results over time because they go back and they study what worked and what did not work, right? So you're measuring progress in trends and not in single trades. Now, the opposite of that is neglect mindset, right? Decisions made in isolation, rarely revisited. You're relying on memory instead of a written record of what you did and why you did it. This confuses being busy with making progress. So an example of that would be having to trade every single day simply because you want to feel productive, which in my opinion is a terrible, terrible philosophy to have with respect to trading overall, right? You do not have to trade every single day. This also assumes that things will hold up on their own, right? Again, neglect mindset. You're neglecting making decisions and documenting your process. And that is holding you back from progressing over time by understanding what you're doing wrong. And also the last thing is uh, you only notice the problems once it's very expensive. So maybe you've already blown up an account or two accounts or three accounts or lost a large sum of money, and you're wondering, how did this happen? How did I go from, 100K to 10K or $1 million to $250,000, right? There's always that funny joke on Reddit, which is, how do you make $1 million in trading? Start off with $2 million, right? Again, you want to think about your process and understand what you're doing fundamentally. If you do not do this, it's impossible to progress. I promise you this. So, from buildings to balance sheets, what maintenance actually looks like when you're managing a portfolio, right? So, the core idea here is that well-maintained systems don't stay good by accident. They stay good because someone keeps checking on them and logging what changed and fixing small issues before they become structural ones. And a portfolio is no different at all whatsoever. I see this often with portfolio managers that I consult for. There's a lot of complacency in how they manage their portfolios. And I find that is detrimental to the overall returns that they provide for their clients because they're not being active about managing their portfolios. I won't get into that, but the point here is one, trade journaling, right? Every position you take gets a written thesis, entry logic, and target before your capital moves, right? You could have, for example, an idea like Microsoft. When Microsoft was back down at 350 a share, you might have said, okay, well, the price right now is the same price it was trading at in November 2022. So basically, I'm paying the same price as it was at 4 years ago. However, they've had so much progress in 4 years. They're also trading at a forward P of 18 at the time when they were at 350 a share. That could have been your overall thesis, right? Or your logic. And then you might have a target and said, you know what? Once we hit $500 per share from 350, I will sell half and de-risk my position because we'll have gotten into that target range of where I expect the price to move to. The next thing is documenting invalidation. You define in writing the exact condition that proves the thesis wrong. So let's say, for example, that back to the Microsoft example, maybe they miss earnings. CapEx was far higher than expected, right? These can all invalidate your overall thesis and kibosh the reason why you're in the trade overall or the investment as well, right? This applies to trades or investments. The next thing is periodic review. Past trades should be revisited on a schedule, not just when something goes wrong. Now, I offer all my students that I work with one-on-one the opportunity to review their portfolios, once a month by looking at their trade journals. You want to know how many people actually do that of all my students? 6% of my students do that out of hundreds of people I worked with. 6%, because most people don't document their trades. Unfortunately, it's a function of getting complacent when you see success. And again, by being successful, you can learn from your success to be even more successful, perhaps, or also learn what is working, but also what's not working in your trading that can make you, improve your overall decision-making process. The next thing is portfolio rebalancing. This is a very, very important facet of managing one's portfolio. Position sizing and exposure are checked against your plan and not allowed to drift. So when a position balloons in size, for example, let's say that you got into an AMD when it was like $10 per share. Now it's, 470 a share. If you allocated, for example, 5% of your portfolio back then, you'd be up right now, what, about 80, almost 90 times your initial investment. At some point in time, you have to de-risk your positions because when a position gets too large in size, basically it becomes your entire portfolio. It's very important to consistently review your portfolio and analyze what your sizing is on each position. And if a position has ballooned heavily toward a price target, for example, it is your responsibility to de-risk it. Tax implications be damned. It's important. Again, a lot of people say, you know what, I don't pay taxes. I'm gonna wait to sell a position. Once you get a target, ultimately paying taxes is kind of like a rite of passage to making profit in the market. You should be proud of that, even though it's kind of unfortunate because you have to, pay tax on your profits, right? Um, the next thing is the compounding cost of neglect. Undocumented decisions don't just disappear, they quietly repeat themselves, right? So you have repeated mistakes. Without a record, you can't tell a new mistake from an old one wearing a new ticker. You have revisionist memory. Your recollection of why you entered a trade quietly rewrites itself to protect your ego. And lastly, you have no feedback loop. Without logged targets and outcomes, there's nothing to measure your edge against. Neglect is invisible right up until the moment it's expensive. And this is very, very important to understand. Again, you might be wondering like why I'm talking about this, but this is kind of like the hidden side of success in the market, right? Those that maintain versus those that neglect. And it's not often talked about because it isn't very sexy to talk about, right? But ultimately, if you don't document your decision-making process over time and revisit it repeatedly, you're gonna never really learn where you're going wrong or where you're going right. And a lot of the benefit in my experience, especially as a more experienced investor, is that I can kind of see where I can cut the fat from my trading, right? And by that I mean what isn't working that's dragging on my returns that I could perhaps remove from my decision-making processes. And that will augment my returns in a positive manner by simply just removing bad decision-making processes. So for example, you might notice that when you're trading very, very short duration, like zero-day options, for example, you might notice that you're not winning overall. And by studying yourself and saying, over the last 6 months, I have not net profited by trading zero-day options, maybe I've lost, versus my midterm trades, my swing trades, perhaps my long-term investments have performed very well. That tells you stop doing the short-term trading where it is very binary in outcome. And often um, uh, the outcomes are dictated by a lot of noise that happens, tweets, truth social posts, right? Or some kind of data point that comes out, GDP perhaps, or a CPI number, for example, or an FOMC meeting, right? These are all noise data points that come out in the short term that affect your short-term trades. But in the long run, your investments typically will reflect the fundamentals of the company that you're investing in, right? So the next thing is the compounding benefit of maintenance. The payoff isn't any single review, it's what accumulates across hundreds of reviews, right? So you have pattern recognition over time. A logged history lets you see which setups, sizes, and conditions actually work for you, not in theory, but in your own data. This is very, very important. Like one thing that I noticed with one of my students recently was that they were buying too far out of the money options, even though they had great ideas and great setups. They were buying far too far out of the money with far too short dated options overall. So the idea there was that they had a great thesis recurringly, great ideation on their setups, that they express their setups in very, very short durations, typically, 1 or 2 weeks or a month at max. And they would buy positions out of the money because they wanted to reflect a very, very strong positive asymmetry of risk. And by simply changing that process and saying, you know what, I have a good thesis, I've proven that, but I'm not expressing my trades positively. All I have to do is change my overall strategy that I'm using, right? Buy more time, buy closer to the money, use spreads to reflect a lower required move to actually get my position in the money, perhaps, right? The second thing is accountability to your past self. You can't quietly reframe a bad trade as intentional when your own written thesis says otherwise, right? Very important, right? You can go back and see why you made decisions, and you can't lie to yourself and say, you know what, I thought this would happen, and it did happen, or it didn't happen. You actually see what it says in the data itself. The next thing is, and the last thing is, faster identification of your edge. You stop guessing at what's working and start reading it off the record months sooner than intuition alone would tell you. The next thing is a practical trade journal framework. So what to actually capture every single time you open a position. Number one, your trade thesis. Why this trade in one or two sentences, the actual reasoning, not just the ticker itself, right? So you could say, for example, NVIDIA reports tomorrow evening. They're trading at a forward P right now of about 17. They just raised their prices by 15%. SpaceX in their earnings call, for example, said that they will only be purchasing NVIDIA chips going forward. These are all very bullish catalysts for NVIDIA. That could be your thesis, for example. You might say they've kind of consolidated in this range and haven't really moved too much in the last year or so. And I expect a breakout to $250 to $300 per share in the next 6 months, for example. That could be your thesis. Your next thing is your entry criteria. What specific condition triggered the entry? Price, IV, catalyst, technical level, right? You might say, okay, I want to get in at a certain support area. On NVIDIA, that would be 190 a share, for example, a very, very heavy support area. That'd be a great entry point for anyone that is currently not in NVIDIA, perhaps. If they were to beat earnings all around, raise guidance, and still fall, which has happened the last 4 earning reports. That's just an example here, guys, not financial advice. Remember this, right? Number three is a target, the price or condition at which you take profit set before you're emotionally invested. So again, like the Microsoft trade we mentioned or investment we mentioned, when it was 350 a share, the target for me was between $500 and $600 per share, ideally 550 to $600 per share. But that being said, as it goes higher, it's prudent to de-risk to remove emotional attachment to the trade, but also maintain an appropriate size of each position in your portfolio. Number four is the invalidation level, the exact point that proves your thesis wrong, which is your pre-committed exit. You might say, for example, I want to get into NVIDIA at 190 a share. And once you get into it, you might say, okay, well, if we break down below 165, which is the 1-year low currently, then that would invalidate perhaps your short-term thesis on why you're going to hold the trade, right? Again, this is a trade, not an investment. If you're investing, you have to think about it long-term perspective and understand what you're investing in and why, right? And maybe you want to be adding on those levels. If it's a trade where it's a short-term, target where you're trying to swing a position and try and make whatever 1, 2, 3, 4, 5% return in your portfolio, depending on what your target is, you need to understand that it can be invalidated, and especially on a short-term basis. If it's invalidated short-term and you have an expiration date on an option contract, for example, you have to realize that it can go to zero, and therefore you should always stick to your targets and maybe remove your trade if and when it hits that target exit point. Don't say, you know what, I'm going to add to it, double down, perhaps, which is a key mistake I see a lot of people making. Or you're going to say, you know what, yeah, I hit my target to stop out at, but I'll give it another day or two, and then before you know it, instead of losing half, maybe you lost the entire position. Number five is the emotional state that you're in, right? An honest one-line note on your headspace going in, right? And a good thing to do is perhaps even have a numeric system between 0 and 10, where 10 is like, your best mental state and 0 is your worst mental state, and put that in your journal as well. Maybe you had a problem with a family member, perhaps, or a friend, or something happened at work, right? We all have problems in life, and they can affect our emotional state, even in trading as well. So very, very important to document the state as well, because over time you'll see that maybe you should not be making decisions when you're in an emotional state, right? A very, very key outcome that I had with one of my students. The last thing is the outcome and the lesson. What actually happened and the single takeaway you give a friend making the same trade, right? So what happened? What was your thesis? What was your entry criteria? What was your target? Was it invalidated at all? Or did you hit your profit target? What was my emotional state? And then what was the outcome of that trade or investment? And what was the key lesson I learned there, right? Um, now applying this to life, not just trading, because again, ultimately we're trying to in endeavoring to trade, the overall goal here is to make money to live our lives. But a very, very important thing is to understand that this mindset, maintenance mindset, can be applied as well to your life, not just trading. And it's important that we apply this to our lives as well, right? So it isn't just a trading principle, it's a life principle. Every domain that matters to you runs on the same maintenance versus neglect switch. Your portfolio just happens to send you a monthly statement about it, right? So the same discipline everywhere else. Periodic inventory taking applied outside your brokerage account. Number one is your health, right? Blood work, checkups, dental visits done on a schedule, not only once something already hurts, right? I know so many people that are getting older in my life where they just neglect their health and then something happens and all of a sudden they're like, oh, you know what? Maybe I should start taking statins or start, exercising, for example. Don't wait till something bad happens to make a change. Make that change now, and it can be a small change, right? The next thing is relationships. You know, checking in with people that you care about recurringly is important. Not letting distance grow between people, right? Over time, as we get older, our time is more precious and more scarce, perhaps. But ultimately, it's up to us to maintain our relationships, which is very important as well. Again, maintain a maintenance mindset around relationships. Next, we have personal finance, budgeting and saving treated as a recurring practice, not a one-time resolution each January. And then we have, of course, physical assets, our house, our car, for example, right? Oil changes, home upkeep, device backups, etc. Small actions that prevent expensive failures over time, right? So keep this in mind as well. I don't preach it all whatsoever, but it's important we think about this, guys. And again, I know that for my YouTube channel, the demographic that's following me pretty much is 90% between the ages of 25 and 43, and mostly male. So we're in this bracket where we're progressing toward, perhaps 35, 40 years old. You want to think about this stuff before bad things happen. Very important. Again, and it's important that whatever actions you take are sustainable over time. So for example, if you want to start working out, don't make it a target to go to the gym for 3 hours. Say, can I budget half an hour a day to go for a walk or do some push-ups? That's sufficient in certain respects just to get started. And again, it's all about progress, not perfection, guys. So the common thread here is maintenance mindset means treating your future self as someone worth protecting through present discipline. Very important. Present discipline. Doing things day in, day out that maybe you don't want to do, perhaps. Like, I don't want to always run in the morning, perhaps, to go to the gym, right? But I do it day in, day out because I feel like I want to live longer and I want to live a healthy life as well. I want to feel good, right? Reading, for example, right? It's important to do these things day in, day out and express them through discipline, right? But maybe you don't have the time, for example. Maybe you're busy with a job and you have kids, right? Again, budget small amounts of time, small changes over time, even a 10-minute workout, 10 minutes of reading per day, that will perhaps elicit more interest in doing those things over a longer time horizon as well, right? What's sustainable? Again, ask yourself the question there. And the last thing is, starting this week, pick one maintenance habit in trading or in life, or perhaps both, and run it for the next 30 days. In your trading, log your thesis, your target, your invalidation level, or stop loss, perhaps, on every single position. No exceptions, starting with your next trade. A good way of doing this, by the way, if you're busy and you're trading very actively intraday, is screenshotting your charts and screenshotting your option chains and documenting, your IV, your HV, the spot price of the asset you're trading, for example, the Greeks on the asset you're trading options, the prices of each option, obviously. Very, very important to document these things. But again, if you're busy trading during market hours, maybe what you want to do is just screenshot and then later on document it. And then in one life domain, Pick health, relationships, or finances. Schedule one recurring check-in this week. A calendar reminder counts as well to look at one of those things, or perhaps even one of all three. But again, I express starting small is important. I know that not everyone wants to tackle all three at one time. So pick one thing perhaps for yourself. Maybe drop a comment below if you want to talk about something that you want to do yourself. I'll be happy to give you some feedback perhaps on my process and what works for me. But otherwise, have a great week, and I'll see you guys all next week.